was to make a free cryptocurrency trading course that's better than the courses that people are selling for thousands of dollars, and to do this for free on our YouTube channel. And inside of this cryptocurrency trading course, we're going to cover a lot. I'm going to assume that you're a complete beginner. You don't know really anything about trading, and we're going to walk you all the way up to like an advanced level of trader, at least to the intermediate level of trader. But the difference is I'm going to make things really, really simple. And also, I'm going to share with you information that not a lot of other people have access to, because I've had the chance to partner with a guy that's actually been trading cryptocurrency since it was like 1 penny. So he has over a decade worth of experience. And I'm going to teach you everything that I've learned to become a profitable cryptocurrency trader. So with all of that being said, let's dive into this. This is how it's going to be broken down. It's going to be broken down into multiple videos. Okay, the first video today is going to be part 1 about the crypto basics. Step 2, we're going to be talking about charting. Third, we're going to be talking all about indicators and how most of them are BS and which ones you should actually pay attention to. 4, we're going to talk about trading systems and what are the components of a trading system and a profitable trading system. Part 5, I'm going to talk about our favorite cryptocurrency trading strategies. And don't just go skip ahead to that point right now, or else you're going to miss all this other important foundational stuff that we build upon each video. And number 6, we're going to cover trading psychology. Because even if you know all the basics and you know how to actually execute a trading strategy, a lot of the times people can't become profitable because they have it all messed up in their head and they think about trading wrong. Okay, so we're going to talk about that. Now, make sure that you like, subscribe, and turn on post notifications so that way you don't miss the future videos that are coming out on each one of these different topics. So today in the first video, we're going to be talking about the crypto basics. And I'm going to assume that you don't really know a whole lot about trading, and we're going to bring you up to speed. So we're going to go over choosing the right broker and why this is one of the most important things to becoming a profitable trader. We're going to be covering the basics of TradingView, which is our charting tool. I'm going to cover what are the X and Y axes and what do you need to know about them. We're going to be covering different time frame analysis. We're also going to be covering candlesticks, and we're going to be talking about the constant war between buyers and sellers. We're going to talk about cryptocurrency trading pairs and order types and which assets are the actual best to trade. So let's go ahead and let's dive into this right now into, first off, choosing the right broker. So choosing the right broker is one of the most important steps in becoming a profitable trader, because a lot of the times brokers can be scams, or they can actually take a large percentage of your money by causing outrageous fees. So the first thing that you want to look for in a broker is, 1, you want to look for one that has low fees. 2, you want to make sure that it has a variety of different tradable assets. 3rd, you want to make sure that they already have a large number of customers served and it's not some new flash in the pan exchange that comes up. 4, you want to make sure that they have great customer service. Ideally, if they have live chat support, that's fantastic. Next is you want to make sure that it has an easy interface to use. And let's go ahead and talk about this. So there's a lot of different brokers that you could use out there. The one that I happen to like to use is called KuCoin. Okay, KuCoin is great because they don't ask for all of your information. They've been around. They serve tons of clients. They have really, really small fees. And they actually offer live chat support, which is one of the few brokers that I know of in the cryptocurrency space that actually offer that. And they offer a lot of other cool stuff about different ways that you can earn passive income. They have a great, easy to use interface. So I use KuCoin. You're welcome to use Binance. If you already have an exchange set up, then that's totally fine. The rest of this tutorial is still going to be useful for you because most of the interfaces are very, very similar. So with that being said, if you'd like to sign up for KuCoin, I did include a link in the description below, so that way you can save even more on your trading fees. So once you have a brokerage set up, then obviously you're going to want to fund the brokerage. So you can either send cryptocurrency directly to your brokerage account, or the cool thing about KuCoin is you can actually pay and buy crypto with your credit or debit card. So it makes it really, really simple to get your money onto an exchange, so that way we can begin trading. The next thing that you're going to need before you get started is our favorite trading charting tool called TradingView. So you can go on over to tradingview.com and you can actually sign up for a free account. They have a web version of this, so you can analyze everything on the web like this, so you can see the charts. But this is basically going to help us with different charting tools that we're going to be talking about. So you can do it online, or you can also download their app and you can actually have it on your computer, or you can also have it on your phone. So this is called TradingView. So make sure that you set up a TradingView. make sure that you set up a TradingView account if you're unfamiliar. We're going to be using TradingView a lot throughout the rest of this tutorial and course, so make sure that you have an account already set up. The next thing that we're going to be talking about is actually the X and Y axis. So when you're looking at a chart, you'll notice a few things. You'll notice that on this Y axis here, we have price, and on this X axis here, we have time. So we can also change the time frame, which we're going to get into later. But basically, you'll see that the time changes down here. The date and where the price has been at also changes here. Okay, so this is the X and the Y axis. So this is what we're looking at. And then on the chart, we see these little things called candles. Okay, each one of these candles represents a period of time. So for example, if I go to the daily chart just like this, each one of these candles actually represents one day. Now, here's how to better understand candles. The candles are made up of 4 different parts. There's the low, the high, the open, and the close. And essentially, the low is the lowest that this candle has gone, or that price has gone during this, for example, 1 day time period. The high is the very highest that the candle, or that the price has gone during this 1 day period. The open is what the session actually opened at. So when the day actually started, where was price? And the close was at the end of the day, where was the closing price? Okay, so if it's opened here and it closed here, it printed a green candle, which is a bullish candle, which basically means that there was more buyers in the market than there was sellers. Now, on the opposite side, we have bearish candles, which are represented by red generally, where you can see, again, we have the high, the low, the open, however, is here, and the close is here. So it means that at the start of the day, price was here. The close of the day, the price was here, so it was less. So this is a bearish candle or a downward candle. This would be an upward candle or a bullish candle. But generally, you'll be hearing the words bullish, which means price is moving upwards, or bearish, which means price is heading downwards. Okay, here's another way to look at a candlestick is we can see this is the daily candlestick, which again, we have the open, the close, we have the low and the high of the candle. So this is obviously a red candle because it closed further down than when it opened. But also, if you break that down into the 4-hour time frame, we can see that each one of these candles represents 4 hours, which in total, there's 6 of them because 6 times 4 equals 24 hours. 24 hours in a day, you have the daily candle. So on the 4-hour, we can also see it. So we can see the very high during this day time frame was this candle here. We saw that it opened right here. We saw that this session closed right here. And we can see that the low was all the way down here, which it's the exact same price points as we see in this daily candle. However, we just see this broken down into 6 individual 4-hour segments. So with that being said, there's a lot of different what are called Japanese candlestick patterns. And each one of these patterns has a different psychology and means something different. So I'll go ahead and I'll just point out some of the most common candlestick patterns that you may want to look for. So this is a very common candlestick pattern. We saw a red candle here, and then we see a very big green candle right next to it, which completely engulfs the previous candle. So this is what's called a bullish engulfing candle. And generally, when you see this, price generally heads on upwards, okay? The other type of candle, or the reverse, would be like a bearish engulfing candle. So this would be an example. You see this big red body that's engulfed the previous entirety of this candle. So this would be a bearish engulfing candle. One other candlestick pattern that you may want to pay attention to is something called pin bars. And a pin bar is basically, it has this body up here, and then it has a long wick. And you can think of the wick is basically these top ends or this bottom ends. These are called the wicks of the candle, and then this center area is called the body of the candle. But as we see here, we have this smaller body and we have this long wick. So what is this telling us psychologically? It's telling us that price tried to go down here lower, but it didn't want to, and actually price ended up coming up here. So basically, this is psychologically telling us that the bears tried to win over here. They went all the way down here, but the bulls came back and they fought it all the way up to this point. And this is generally a likely scenario where price is going to continue on upwards. You can also see this candlestick pattern in the opposite direction. You see this smaller body with this long wick up here, which basically means that price tried to go higher. It really didn't want to go higher. It flowed all the way down. market. And that's really what the charts end up making up. And that's what these candles make up, is it shows the psychology of what's happening in the market between buyers and sellers. Okay, now we're going to be talking about cryptocurrency pairs. So what are cryptocurrency pairs? You'll notice that whenever you're trading an asset, you're trading it against some other asset. So in this instance, you see that there's BTC USD. This is called BTC. In this case, the first one is called the base currency, and then the second one is called the quote currency. So the base currency is Bitcoin. The quote currency is the US dollar, okay? And you'll notice that it's always traded in pairs. And you can see here's Ethereum US dollar. So Ethereum in this case is the base. The US dollar is the quote currency is what it's called. But you're trading a pair. You have to trade one asset for another asset. Now, in this scenario, we can see that if price is going up, then we would want to buy Ethereum US dollars. So we're buying Ethereum because we think that Ethereum is going to go up in price relative to the US dollar. And not always is it tied to the US dollar. In this scenario here on KuCoin, you can see this is Ethereum Bitcoin. So Ethereum in this case is the base currency and Bitcoin is the quote currency. So in this scenario, if we think that Ethereum is going to go up more than Bitcoin is going to go up, then we'll buy ETH BTC because we think that ETH is going to become more valuable compared to Bitcoin. Now, before we get into the different type of market orders and what assets are actually the best assets to trade, going over to Instagram and go to Blue Edge Crypto and follow us. I want to send you a free report, which basically is going to show you 7 different passive income opportunities that you can earn with cryptocurrency. All you got to do is go on over to Blue Edge Crypto on Instagram and message us the word passive. And when you do that, we're going to send you a free report with our 7 favorite ways to earn passive income in the cryptocurrency ecosystem. Okay, so now we're going to talk about different order types. So these are the most common different order types. So what does this mean? When you go to actually place a trade, there's different options that it'll give you on how you can place this trade. So let me tell you what this means. So now we're going to talk about the most common order types. Now, what does this actually mean? This means that when you're going to actually place your trade, say you want to buy Bitcoin or you want to sell Ethereum, there's different types of orders that you can make in order to execute it. I know this may sound a little bit confusing, but I'll make it really simple, okay? So there's market orders, there's take profits, there's stop losses, there's trailing stop losses, there's buy and sell stops, and there's limit orders, okay? So let's get into what each one of these means. The first one is called a market order, and you can either buy or sell at the market price. So what does this mean? This means that you're going to instantaneously enter the trade at the best market price that's available right now. So no waiting, for example, you just get right in. You can either decide to buy or sell whatever the price of the asset is right now, okay? The next type of order is what's called a take profit. So, for example, let's say that you put a market order right here to buy, and you then want to take profit up here. This means that basically when price reaches that point, you're going to sell the asset and it's going to convert back into a profit for you, right? So you can set this order on the brokerage that you're trading with, so that way when price hits there, you automatically take profit. Now, the next thing is that you could do this in the opposite direction. So say you're taking a sell order right here, say you're doing a market sell order, meaning you're getting into the market right when the market price is available, and you put the take profit down here, it's down below because we're expecting price to go lower. So when price comes down here and actually hits this, then you will be taken out of the trade and you will earn profit, okay? Now, the next thing that we're going to talk about is what's called a stop loss, okay? And what a stop loss is essentially, let's say that we want to sell right here at the market price and we want price to go to this point. This is our take profit. But we may also want to put a stop loss right here. And essentially what this means, if the price goes against us, okay, and we're losing money in this case, we want to get completely out of the market at this stage right here, okay? So if price comes up to here, then it hits this, then we'll get taken out, so that way we cut our losses lower. Now in the opposite direction, again, let's say that we put a buy order right here, and we put our take profit right here, and we put our stop loss down here to protect our bottom downside. Price comes up here, boom, in this case, and it hits your take profit. However, if price were to come down here, it hit our stop loss and we'd get taken out of the market right there. The next thing is what's called a trailing stop loss, and this is a little bit more advanced, but basically, let's say that we put a buy order right here. Let's say that price moves on up to this point. We can move our stop loss or trail our stop loss. So essentially, let's say we put our stop loss right here. When price is up here, this basically moves our trade to break even at this point once price has risen. Let's say that price rises again, we can continue to trail our stop loss. So this way we're locking in profits and we're actually limiting our downside. So again, price moves higher, we move our stop loss even higher, and then boom, we get cut out right here, okay? But we capture a big portion of this move thanks to a trailing stop loss. The next type of order are what's called stop orders, okay? And you can have a buy or a stop order. For example, you want to enter the market as soon as price gets up into this point. So you put a buy stop here, and when price moves past this, you automatically enter right at that price there. Okay, so for example, price comes up, and as soon as it comes up and it hits this line, then we'd actually enter the trade. Okay, so that's a buy stop. Now a sell stop is the total opposite, right? We can put a sell stop down right here, and when price moves to this level or past this level right here, this is where we're going to enter the trade. So we would have entered the trade right there. Okay. The next type of order is called a limit order, okay? You can have a buy limit or you can have a sell limit, but in this case, let's say that price is here, but you think that's too pricey, that's too expensive. I want to wait for price to come down here until I actually enter my orders. You wait for price to come down here, and then once it comes down below and it starts coming back up, you'd actually enter the trade right here, okay? Same thing with the sell limit. Let's say that you think that price is going to come up here before falling even further. Then you put a sell limit right here, it would come up here, and it would come on down, okay? So you'd enter the trade right here. So these are the different types of market orders. So we've covered choosing the right broker, trading view, X and Y axis, time frames, candles, buyers for sellers, pairs, order types. Now we're going to talk about which assets are best to actually trade. Now, when trading cryptocurrencies, you want to make sure that you're trading the best assets to trade. Now, with cryptocurrencies, since there's like 10,000 different cryptocurrencies, sometimes it can be difficult to get in and out of certain trades to find somebody to buy if you're selling or to find somebody to sell if you're buying in this scenario because there's low liquidity. What does that mean? That there's not enough people actually trading this market. So when you're trading, you only want to trade coins that have a lot of volume or that have a high market cap. So generally, it's a safe idea if you're going to be day trading cryptocurrency that you probably just want to trade cryptos that are like within the top 10 or maybe within the top 25. Anything outside of that, you may get stuck with liquidity issues where it's hard to sell your asset when you're ready to get out. You may get stuck holding something longer than you'd like to. So primarily, we actually like to trade just Bitcoin and Ethereum. They're very, very volatile. Bitcoin and Ethereum. They're very, very volatile assets, and they're also very liquid assets. So that means we should have no problem getting in and out of trades. Okay. Now we've covered a lot in this video, but the next video in this series is really important. Now we're going to start getting into charting. Okay. So we're going to be talking about things like support and resistance. And what most people tell you about support and resistance is just a complete lie and is inaccurate, actually. Second thing, we're talking about trend lines, and we're going to be talking about chart patterns. And in that video, I'm going to show you a couple of secret chart patterns that not a lot of people talk about. But once you understand these chart patterns, you'll be able to accurately predict when the market's likely to start flying off in a certain direction. So make sure that you like, subscribe, turn on the post notifications so that way you don't miss the next video in this series. And we'll see you in the next video. Welcome to part 2 of the best cryptocurrency trading course for beginners. Yes, my goal in creating this course was to make it for free and to make it better than the cryptocurrency trading courses that you can buy for thousands of dollars. So in this week, we are in week 2 or part 2, and we're talking all about charting, where I'm going to teach you about support and resistance, about trends, about the different market phases, about my 3 favorite different chart patterns. If you missed last week's video, then go back in this playlist and you'll be able to catch up on the crypto basics. The third video coming next week will all be about crypto indicators. I'm going to talk about why most indicators are BS and the only indicators that you should really pay attention to. Then we're going to be covering trading systems, our favorite trading strategies, and trading psychology. So with all that being said, let's dive into what we're actually going to be covering here today. Number one, we're going to be talking about support and resistance and how to identify accurately support and resistance. We're going to be talking about the different market phases, which is incredibly important. We'll talk about trends and how to identify trends. We'll talk about using candles, which we learned about in the previous video, and how to combine them with things like support and resistance. We'll talk about different chart patterns, and then next week we're going to follow up and we're going to start talking about indicators. Now, to dive in, we're going to be talking about support and resistance. And to understand support and resistance, you first need to understand that there's different types of support and resistance. The most common is what's called horizontal zones, which I'll show you in a second. We also can have support and resistance off of trend lines, and we can also have support and resistance off of moving averages. What is support and what is resistance? If we take a look, support and resistance basically means support acts as like a floor that price tends to bounce off of, and resistance acts as like a ceiling that price tends to bounce off of and has trouble breaking through. So generally, these are what are also called key zones or key areas that you want to look for in trading. And essentially all they are is they're areas or zones where price basically plays off of. They're key areas. And a lot of the times these key areas of support and resistance are actually whole numbers. So in this case, you can see like around $60,000 here is like a key resistance zone in this territory, meaning that we saw price come up to here once. We saw price kind of struggle around here again. We saw price in the zone multiple times, price in the zone a lot, price in the zone a lot, price coming up to the zone and struggling again. So this is a key zone, meaning that price tries to, it interacts with this zone quite a bit, okay? Also, we can see key areas here. This was a key area of support, right? We saw price kind of fiddling around here, hit this zone and kind of came off sharply, hit the zone multiple times, came into the zone, bounced off sharply, came into the zone, rejected it quickly, came into the zone, came into the zone again, came into the zone, rejected it quickly, came in, touched this zone, rejected quickly. So this is another example of what would be called support. Support is like on the lower side and resistance is like on the higher side. So support is like a floor that price bounces off of, and resistance is like a ceiling that price bounces off of. And you can see there's also multiple zones on this chart. There's not just two. You can see here was a key area of support as well. And one thing that you'll notice a lot of the times is that key areas of support in a trend can often form areas of resistance. And I'll get into that when we're talking about trends later on. But this is a little bit subjective on how you draw support and resistance zones, but I'll show you how I like to do it. So if you're having trouble drawing support and resistance zones, one thing that might actually help is actually, instead of looking at a candlestick chart, actually looking at a line chart. And if you do that, sometimes it's a little bit easier to see where these key zones are. Like you see, this is definitely a key zone here, right? We saw that price rejected this area multiple times. And what do you know? It happens to be kind of a round number, $40,000, right? It rejected here. It's rejected a whole bunch of times here. It's rejected here. It's acted as support here, right? So you see that this is kind of a key zone here. It makes it a little bit easier. We can also see kind of right around here is another key zone where price likes to reject off of, and it also turns into support. So sometimes switching from just a candlestick chart to a line chart can help you find support and resistance. And again, support and resistance isn't a completely 100% accurate thing. It's somewhat subjective, but using a line chart can help you get better areas to draw support and resistance at. The next type of support and resistance are what are called trend lines. So you can see here, I've drawn this trend line. We can see that there's this trend that's popped up right here. And you can see that price, when it comes to this zone or this trend line, it tends to bounce off, right? It bounced off here once, bounced off here twice, bounced off here 3 times, right? So this is an example of a trend line that acts as support and resistance. Okay, another example, here's a downward trend line here, and we can see that every time it bounces off of here, it seems to bounce off quite sharply. And here's one more example of a trend line. Support in this case came down, it's bounced off sharply, came down, bounced off sharply, came down, bounced off sharply again. Now, the last common type of support and resistance are what's called moving averages. And if you're not familiar, we're going to cover moving averages a lot more in depth in the next video, but it's an indicator that basically shows you the average price of a set of data. And if we look at here, we can see that this line drawn on the chart, we can see many times that the price will come down into this moving average and it'll bounce off. As you can see, it came down here, bounce off, bounce off, bounce off. and then it started acting as resistance, bounced off, and then it started acting as support. And so this is another way that you can find support and resistance. Now, the next thing that we want to talk about is the market phases. And this is important when you're trading because depending on the market phase will determine how you want to trade. There's three main different types of market phases. There's a ranging market phase, there's what's called a choppy market phase, and then there's a trending market phase. So let's get in and let's take a look at each three of these. Okay, so first things first is a trending market phase, which basically means prices moving in one direction quite sharply. So as you can see, we were in quite a trending market all the way through here. We saw that, price was continuing to move up, and up. And it could take a third grader to see this, that if you just ask, hey, from here to here, what was happening with price? It was moving upwards, right? It doesn't really take a whole lot to understand that. Generally, to understand that, generally you're going to see what are called higher highs and higher lows, which we're going to talk about in just a second, but it's really easy to identify this. The next type of market phase is what's called a ranging market phase, which basically means that price kind of just floats around inside of this range. You can see here was kind of like a ranging market phase where price would come down to this lower end of the range, and then it'd come up to the top end of the range. Then it'd come down to the lower end of the range, and it'd come up to the top end of the range. It'd come down to the lower end of the range, and it kind of bounces in a range, going up and down in these areas of this range. And then we also have what's called a choppy market, this is the third phase of the market, which we can see kind of like right here. This is really choppy, and it means that price is really compressed, and it's kind of just in this untradable area. You really don't want to be trading in a choppy market generally, unless you're trading some sort of like mean reversion strategy, which we're not going to cover right now. But essentially, price is not really making any beautiful or any big moves. It's kind of just in this choppy zone. Now, the thing to understand about the market phases is the market will always go from trending to ranging, and then from ranging to trending, and then from trending to ranging, and ranging to trending, and it consistently goes back and forth. And generally what happens is when we go from like a ranging market or like a choppy market, these are kind of similar in a sense. Just a choppy market is just a smaller, really tight range, I would say. But once you have this really tight range, like right here, generally what happens is the longer we see the market in a ranging phase or a choppy phase, that means that there's likely going to be a large breakout or a large trend that comes and follows, which we're starting to see right now happening on this Bitcoin chart. So these are the three different types of the phases of the market. They constantly switch from a ranging market phase to a trending market phase. So if you know you're in a really long ranging market phase, you know that likely soon there's going to be some sort of big trend. The next thing that we're going to talk about is trends, okay? Now, there's a few ways to identify trends. One is drawing a trend line, which we talked about earlier, where you're basically just connecting the bottoms in an uptrend, or you're connecting the tops in a downtrend, just like this. This is the first way that you can identify trends, is just by drawing a simple trend line, okay? The next way that you can identify trends is by what's called structure. Generally, in a trend, you're going to see something called higher highs and higher lows in an uptrend. And in a downtrend, you're going to see lower highs and lower lows. So let's dive into the chart and actually take a look at what this actually means. Okay, so in an uptrend, we're generally going to see higher highs and higher lows. Now, what does this mean? So this basically means that, okay, here we see that, okay, clearly the chart's kind of just moving upwards kind of gradually for the majority of this phase of the market, right? So here was the previous high. So this is a high, and then this is the low, right? And in a trend, it kind of moves in this period where it goes, it breaks out, and then it kind of pulls back. Then it comes out, and it pulls back, and it comes out, and it pulls back, comes out, pulls back, right? So this is kind of the way that the market works in a trending market, okay? Now, what do we mean by higher highs? This means this was the previous high, and this is the next high. This means that this is a higher high, okay? And in an upward trending market, we're also going to see higher lows. So this was the low, and then the next low was like right here, right? So there's a higher low. There's a higher high, and there's also a higher low, okay? Coming up here, we also see it came up all the way to here. This is a higher high than the previous high, and then this is the low. This is a higher low than the previous low, okay? Now, in a downward trending market, we see just the opposite. We're going to see lower highs and lower lows. So let's take a look at this, for example. So this was the previous high. This was the high here, and then this is the next high right here. So this is a lower high than the previous high. So it's a lower high. Okay, this is the low, and then this is the next low right here. So this is a lower low than this previous low. Okay, so the market moves in this phase in a downtrend. It has higher lows continuously, and it has lower lows continuously. So the next thing that we're going to talk about is chart patterns, which essentially are a pattern that basically encapsulates the psychology of what's happening in the market. Remember, the marketplace consists of buyers and sellers, and a chart is really just a visual representation of the psychology of the market participants, which is buyers and sellers, right? So I'm going to show you my 3 favorite chart patterns. There's a lot of different chart patterns out there, but these are the 3 most important chart patterns that you want to use in crypto. Okay, the first chart pattern is called a double top and a double bottom. The second chart pattern is called a head and shoulders and an inverse head and shoulders. And the third type of chart pattern is called volatility compression. So let's go ahead and let's dive in and let's take a look at what this actually means. So a double top and a double bottom, okay, a double top and a double bottom, they're just the reverse of each other. But basically, it's really self-explanatory. There's 2 tops. You can see it easily here. Price comes up to here. It rejects, comes back down to what's called this neckline. Then price comes up to here again, and the market's basically saying, hey, we already rejected that price again, and if it rejects it again, then it's pretty clear that price doesn't want to go to this price, and it wants to fall lower, meaning the market participants don't want to buy anything kind of above this range or above this level right here, which could also be a key resistance range, a key resistance zone, right? And then price starts to come down here. So how you want to trade this is you want to enter kind of right around the neckline, which is this line right here. And you want to put your stop loss somewhere up above here, and you want to put your take profit somewhere down here, right? Now, double bottom is just the opposite, right? It's basically saying that it comes down here, price was rejected from this price right here, comes on up to this neckline, it comes back down to retest this level right here, and it rejects again. So we know that this is an area where price doesn't want to go right now. So you basically enter right around this neckline. You put your take profit somewhere up here and your stop loss somewhere below the neckline, or you could even put it, if you want to be extra safe, below the structure here, below the double bottom, or in this case, you could put it above the double top. So let's go ahead and take a look at this on an actual chart. Okay, so here's an example of a double bottom. You can see here, prices came all the way down here. It rejected this zone. It comes up here, forms the neckline. It comes all the way down here. And another thing is we saw these like long wicks, which is also another good sign. But we saw the double bottom come up here, and boom, it breaks off past the neckline, and then it continues on upwards. Now here you can also see an example of a double top, right? So you see price came up here. It didn't want to go any higher. It came back down to what we call this neckline right here. Price tried to go up, boom, again. And it did not want to go that far, and then price rejected, meaning that price doesn't want to go that high, and it comes on and starts falling down. Now, there's also what's called a triple top and a triple bottom, which is basically the same thing, except for price rejects this top area 3 times in a triple top, and price rejects this bottom time 3 times in a triple bottom. Now, the next chart pattern that we're actually going to talk about is something called the head and shoulders. And essentially what this means is there's like this head here, price comes up, doesn't want to go, comes back to the neckline. Price goes up even higher, okay, and it forms like this head, comes back down to the neckline, comes back up to here to this previous shoulder, somewhere around the previous shoulder. It's not always perfect. and then price comes on and starts falling back downwards. This is called a head and shoulders pattern. And an inverse head and shoulders pattern is just the exact opposite. Price comes all the way down here, comes back up to the neckline. We form the bottom of the head here, the upside down head or the inverse head, comes back to the neckline, and we form the other side of the shoulder, and then boom, price takes on off. So let's take a look at these in actual charts. So here on the Bitcoin daily chart, we can actually see a head and shoulders pattern. We can see it coming up here, boom, there's the shoulder, comes down to this neckline, right? Comes back up, here's the head, it's higher than the shoulder, comes back down, it broke the neckline slightly, but then it came back to form this other side of this shoulder, comes back here, and then boom, price went all the way down, okay? So this is a head and shoulders. Okay, now here's an example of what we could see as an inverse head and shoulders. So we saw that the shoulder formed right here, price went down here, didn't want to come back up a little bit like this. Then it came down, went even lower and formed the head here. Didn't want to go there, price came up, price came back down to form this other shoulder, and then price took on off upwards to this area here. So this is an inverse head and shoulders pattern. Now, probably my favorite chart pattern is what's called a volatility compression pattern. Some people will call them triangles or wedges, but basically what is happening is price starts to get compressed into like this compression pattern. So we can see here that price goes up, goes down, up, down, but every time it goes up and down here, it's getting tighter and tighter, meaning that price is compressing, meaning that people don't know which way the asset should move, up or down, and it's getting tighter and tighter. And generally what happens after a volatility compression pattern almost always is we see a large breakout come after a volatility compression pattern, okay? So it could either break up to the upside, or it could also break down to the downside, and it's hard to tell a lot of the times, but anytime you do see a volatility compression pattern forming, generally you're going to find a really nice breakout trade to happen. And when it starts to break out, basically you'll enter, you put your take profit somewhere further along, and you'll put your stop loss kind of below this volatility compression pattern. Okay, so let's take a look at this volatility compression pattern that happened on Bitcoin not too long ago. We can see it kind of forming right here, okay? This is the volatility compression pattern. We see that what's happening, that price is moving up, it's moving down, moving up, moving down. But as you see, it's starting to compress and get tighter and tighter and tighter, and less volatility, and it's getting really tight. And then boom, what do we see? We saw this nice breakout come right after the volatility compression pattern. And what I like to think of this is basically, I heard this from my partner who's been trading Bitcoin since it was a penny, basically, but he described it as, if you think about when you like ring a bell, you ring it, and there's like this really big noise pattern that happens, like boom, and then it rings out, right? The sound rings out, and it gets less and less and less and less and less and less, and the frequencies become less and less. And the same thing happens like if you were to drop like a big rock in like a pool, right? For example, it has these big waves, right? And they flow out, and then they get smaller and smaller and smaller and smaller. And that's what happens kind of in a volatility compression pattern. After there's like a big move, price kind of rings out, and it kind of becomes smaller and more compressed. And then boom, then you can knock it again. Like for example, if you're playing a gong, for example, or like a bell, you can't just knock it. You have these huge moves. You have to knock it, and it makes this big move, and then you let it ring out, and it kind of condenses and compresses, right? So that's the idea behind the volatility compression pattern. So in today's video, we covered support and resistance. We covered the market phases, how to identify trends. We identified the 3 most popular and best chart patterns. And in the next video, we're going to be talking all about indicators. Now, there's something you should know about indicators. The sad reality is most indicators are BS. I mean, they don't really help you at all. They're just telling you what happened with price in the past. And most of them have no predictive future or predictive power to tell the future. So we're going to be talking about our favorite indicators. So make sure that you have some sort of predictive power. So make sure that you like, subscribe, turn on the post notifications, and you don't miss the next video in this series. Welcome back to part 3 of the best cryptocurrency trading course for beginners. And this week, we're going to be talking all about indicators. Now, something that you should know, the sad reality is that the vast majority of indicators are completely BS. I mean, they have no predictive ability to actually tell you what's likely to happen with price in the future. However, there are a couple indicators that actually do have some sort of edge, and I want to show you how to use them in this course. Again, My purpose in making this course was to make it free and to make it better than the ones that some people charge thousands of dollars for. So if you're getting value out of this so far, then go ahead and like, subscribe, and turn on the post notifications so you don't miss next week's episode. We're going to be talking all about trading systems. Now, up until this point, we've covered crypto basics, we've covered charting, and we're going to cover indicators today. Now, next week, make sure that you stay tuned because we're actually going to be covering trading systems. We're going to start putting all this foundational knowledge that you've learned together, and then we'll cover our favorite trading strategies and trading psychology. Okay, with that being said, part 3, we're going to be talking all about indicators. Okay, we're going to talk about 5 different common indicators that are our favorite indicators to use, and these are really the only 5 indicators that you need to use. So first things first, we're going to talk about moving averages. So moving averages are likely the most common indicator that there is, and essentially what a moving average is it's a average of the price over a certain period of time, and it's represented by lines that look like this. So here's how to put it onto your chart. You'll just come up here to indicators, and then you can put on moving average, and you can see that there is a moving average and there's a moving average exponential. So there's 2 types of moving averages. One is a simple moving average, and one is an exponential moving average. I like to use an exponential moving average, and all it does is it simply assigns a higher value or more weight to what's happened to price more recently. So once you put the exponential moving average on, you can change the settings here by changing the length. So this 10 period would mean that it'll take into account the 10 previous periods, the price of the 10 previous periods, and it will plot it that way. So it's always plotting 10 periods previous, and that's how the average actually works. So I put that on here. You can see it in blue here. This is what's called the fast moving average. Generally, you'll use 2 different moving averages in conjunction with one another, one fast and one slow. So you can see I've also included this 50 period moving average, which as you can see is a little bit smoother. This is called the slower moving average of the 2. Okay. Now, again, you can just come in here to the settings and you can change this to whatever length that you'd like to. In this case, I'm using the 10 and the 50. Now, a couple things about moving averages. You can see that a lot of the times moving averages act as like a support and resistance. You can see that price kind of bounces off. You saw it bounce down here to the 50 moving average. It bounces off. So it kind of acts as like a dynamic support and resistance. Now, generally, how you want to trade moving averages is you'll trade the crosses. For example, if you see this blue fast moving average cutting above this slow moving average down here below, this is a signal that you want to buy or get into a trade, and then you can just trade and get out of the trade once these cross again. Okay, this is a very simple way. Okay, and then right here we'd want to actually sell, and we'd trade and would sell because the blue line has crossed under the orange line. Okay, and then we'd exit the trade like right here. Okay, so this is the idea behind moving average trading. You can also use it. You can see if you're in an uptrend, if the market pulls back and it comes back to this moving average and it looks like it's starting to pull away, this is also a good way to know when you could get into a trade in a trend. The next indicator that we're going to talk about is called Bollinger Bands. So to put on Bollinger Bands, you can just come up here to the indicators. You can type in Bollinger Bands and you can just click it and you put it on right here. Now I've already have the Bollinger Bands on here, but you can change the style of it. If you want to make it thicker or if you want to make it a different color, you just come in here, you can change the color, you can make it thicker, but this looks pretty easy to tell. So the Bollinger Bands basically gives you a volatility range